Welcome to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today, we're talking about real estate.
The asset is what creates that income that becomes whatever your tax liability is. Okay, so again, the taxes are a byproduct of the asset you have. So if you're a physician, you're physicianing and you're making income as a physician, you don't need income from your assets. So when you're no longer physicianing, you have the ability to have that passive income. You just don't need it right now. So why pay taxes on it right now if you don't need to?
Hey, Joe and Bob, let's talk about real estate today. This is something that comes up on nearly every conversation we're having with prospective members and then members as we dive deeper into their assets. Real estate is obviously a very good investment opportunity, a way to generate passive income. But as we were talking, we realized that a lot of doctors see it as maybe the be-all, end-all of like what they should be doing to generate that passive income. But there are so many other opportunities out there. So I wanted to start by talking about real estate and maybe the pros and cons there, and then some other investment opportunities that maybe our listeners haven't thought about.
Well, it's funny because there's entire companies that are built around marketing to and serving doctors when it comes to real estate. And it's usually like a coaching program. Come join our quote unquote coaching program and learn how to do this. I'm a doctor too, and here's what I did. And it's sometimes it's selling the dream as, and I think for a lot of those guys, it's the saying applies: when all you have is a hammer, everything looks like a nail. And so they have this great tool, again, real estate, great investment opportunity. But when that's all you have, you just feel it applies to everybody no matter what. And so you pitch that way. And I think doctors get sucked into that. So I think it's an important conversation, mostly for Bob, for you to share with them. Not just, real estate is a good investment, but there are different ways to invest in real estate and understanding what that looks like.
Yeah. It's an amazing topic. So before we dive into the topic, let's make sure that we all understand that this is really for educational purposes only. We are not giving investment advice on this episode. We're not telling you, well, you need to do this, or you have to do this, or you should do this. We don't know your situation. So please take all this information as education information. Go seek additional information from your professionals that you have, or you're welcome to reach out to us offline independently and go through the process of seeing how and what our viewpoint is, if it's more than what this episode will provide. All right, disclaimer. So it's always important, you never know where people come to these podcasts and what they're looking for from these episodes as information of what decisions they want to make. And so we want to make sure it's very clear that real estate is a big world. It is, like with everything, your purpose and your outcome and your goal of what you want to have as an outcome from that real estate. Not just owning it, having it, is accomplishing that goal. And so this is one of the things we do in our discovery process is we got to figure out, what is your goal? And to your point, Joe, a lot of people get really tunnel vision. And within the medical field, within doctors, it's even more so. And because you got to just look at the doctor world, is that doctors make a good income. They make a good living, whether they're an employee or a practice owner, they make a good living. And thank goodness, right? Thank goodness you make a good living as a physician. You give up a decade of your life to learn how to be a servant to us and keep us healthy, whether we listen or not. In some specialties. Other specialties, you're actually fixing us based on your expertise and your know-how. And so thank you so much for giving up your time and energy to pour into you so you can pour in and serve us into us. I think that's really important to adjust. And we've done the same thing. This is why we're so unified with doctors, is because we're doing the same thing, just not from a medical field, but from a asset and a tax perspective. So your outcome needs to be very important. Needs to be very specific of what you want to do. And so when doctors are looking at real estate, is because you have extra money, it takes extra money to go into real estate. And so you're going to have a lot of doctors that are in real estate that are pitching or marketing their real estate company or their real estate fund, or, hey, I work with this real estate group and I'm their spokesperson because they want more of you to invest in more of them. But why? What's your outcome? What is your individual outcome? What do you want? You want tax savings? Oh, there's a lot of guys pitching and marketing tax savings. Well, I cringe at that because the IRS gives us gifts, deductions, they give us tax savings, but they don't like when we market it and we promote it. And I'm using the word promote very specifically. They actually find that if people are promoting this area, they eventually go back and change the rules of why this is such a great tax benefit. Now, they're not going to eliminate tax benefits, but they can certainly shrink it. Every power and authority to do so. So I think we need to remember that is that you're not doing this just for tax savings. That is a byproduct and a benefit. Like we always say, if you've watched our episodes, thank you, by the way, for subscribing. If you haven't subscribed, let's use this opportunity to say subscribe, give us a thumbs up, add comments below. There we go. Another little blurb in there. It's very important to understand why you want to do what you want to do. And the IRS is very, very giving. You're not going to hear that a lot. They're very giving in giving us these types of opportunities. But we need to know why and how we're doing what we're doing. Okay? So if I am just doing it for tax savings, well, guess what? Based on the rules and guidelines of real estate and tax savings, there are limitations. There are guidelines and rules. First of all, you got to be a real estate professional. Well, what's that mean? Well, you got to basically be in real estate full time. Didn't it used to be that way? You used to be able to invest in real estate, get tax benefits, but what started happening? People started promoting real estate as tax savings. The IRS said, hang on, you're not, and they became very, very more specific on defining how you can get these real estate benefits. Okay. So I want to make sure that that's very clear is why you're doing this. Well, it should be like with all businesses. I'm looking at an asset to appreciate and accumulate that can create income today or income later on. Okay. In real estate world, it'll be more passive income because you are not actively in it. You are not a real estate professional actually making that income. You're not buying and selling real estate and earning commission or anything like that. Okay. You're a doctor and your tax return proves you're a doctor based on your income, right? So that's very important to understand is that you're looking for an asset. The asset is what creates that income that becomes whatever your tax liability is. Okay. So again, the taxes are a byproduct of the asset you have. Okay. And we're going to keep saying this in every episode. We need to say it because you're probably sitting there, Bob, you've said this before. Absolutely. I need to make sure it's very understood and the purpose and reason why we're doing this. It's for your protection. So an IRS agent can't say you're only doing this for tax savings. Okay. Very important. So just like with all assets, here we are, real estate. So there's kind of some of the background. What kind of real estate? Do you want to do a home? You want to be a homeowner and you actually own single family homes and you wear a tool belt and you fix the plumbing and, you fix the fencing when it falls down, you clean out the gutters so it doesn't, is that, no, well, of course not. Now, some of you may want to do that. Just get my mind off of my practice and that's my happy space. Awesome. You know your purpose. Great. Not saying don't do that. That's your happy space. Some may be reading, some may be the family. Okay. But since COVID, that area of real estate investing has shifted and changed significantly. In my opinion, again, seek your own advice and your own research. I think it's a very poor way to build a real estate portfolio. Okay. First of all, your rental risk is 100%. Well, what's rental risk? Well, renting it out, you have one renter. You don't have a renter, you have no income to cover any expenses. Those are your expenses. Oh, I can handle it. Awesome, then do it. But your rental risk is 100%. Your ability to get people out of there not paying an eviction, depending on the state you are, it's a longer period of time in certain states than others where you're not earning rental income. So you got to be prepared for that. Versus if I have a duplex, now my rental risk is 50%. Fourplex, 25%. 300 units, 1 in 300th, right? So it really, you got to look from that perspective of, okay, I want to create passive income. Well, if I own one single family home, I have no passive income. Well, yeah, Bob, I have 10 single family homes. So my rental risk is 10%. No, you have 10 separate 100% rental risk. As a portfolio, you have multiple assets in your portfolio to spread your rental risk. Versus if I have a 300 unit apartment complex, that's one singular investment asset. That's 1 in 300th rental risk. Now, if I have 10 300, you get the idea, right? There's a difference between one asset and a portfolio of assets. A lot of times we don't think about that. And a lot of times this is an easy way to get into investing because, well, we had a condo or we had a starter house, I got out of residency or I got a new job or my practice is kicking off now, whatever. And now I'm making different money, serious money, better money, however you want to term it. And we went into a nicer house or bigger house, more fit for our family. We had more kids, whatever. And so we kept this and we just decided to rent it out. That's where most start. And they start getting these checks and they're like, oh, this is cool. I'm getting checks, not thinking that they're sending checks out, right? They're paying for the mortgage, they're paying for the electricity, they're paying for insurance, all this kind of stuff. Not knowing that when they actually file their taxes, if there's more expenses than rent, they're not getting those losses. Not knowing that one of the great benefits about real estate is the depreciation. Don't get a lot of depreciation in single family homes. So you're not getting a fair amount of tax benefits, which is okay if that's not your goal. Right? But if that's your goal, you're not going to get a lot of that passive losses because you're not a real estate professional. So that's one area. How about storage units? Okay, great. What do you know about storage units? Right? What about hotels? Great. What do you know about hotels? What about strip malls or commercial? Well, great. What do you know about that? Right? For us, we prefer to stick with the very human basics of needs. Roof over my head. It's a basic need. We all have. Could be a tent, could be a cave, could be a shack, could be an apartment. Right? So for us, we actually prefer our members to be in multifamily because if you're getting into real estate, it's a basic need that is there, has been there, will always be there. So it's a safer, so to speak, not guaranteed, but it is a safer way to have your asset accumulate and grow. 300 units, you have 300 rent checks coming, right? Well, some of those units are not rented out. Back to rental risk. You get to spread it. When you have more units than not, you can have a professional manager. It doesn't have to be you. So when we work with our team and we have our own fund we've established with our real estate partners that we've worked with for the last 6 years, established our own fund for our own members. We don't market it on Facebook. We don't give it to anybody. It's specifically there, designed for our members' purpose, based on how we do planning, based on how we categorize tax savings, how we do things for our particular members. So we have a purpose. Does that mean you have to do it? Absolutely not. But we have 2 pathways to use that asset to benefit you from an asset growth and passive income and use of that passive income, as well as a tax benefit. Now, that's very important. That's what we look at. Now, there's other avenues of real estate, right? There's tons of avenues of real estate. But the key is that you can't not be tunneled visioned in one particular asset. And the reason being is that there will always be a tax liability at the end of that road. Always. And I'm not saying just selling that property or that asset. I'm talking about on an income basis. So if you're a physician, you're physicianing and you're making income as a physician, you don't need income from your assets. You need passive income, but we use that passive income in our tax planning to be able to help you reduce your tax liability. And we have a whole formula of how we do that. So when you're no longer physicianing, no longer doctoring, you have the ability to have that passive income. You just don't need it right now. So why pay taxes on it right now if you don't need to? Or you don't need it, I should say. Okay. And the only way to do that is with other assets. You can keep using real estate, but one of the great benefits about real estate is the depreciation. It's a gift the government gives us. Here's how I know it's a gift. If you look on the Schedule E on your 1040, okay, so doctor, if you have real estate, go look on your 1040, go on to Schedule E. That first page of Schedule E is where we have our real estate investing. Okay, that's if you own the property. So you have the address and the line, all this kind of stuff. Now, if it's in a partnership, it's going to be on page 2 of Schedule E, where your S corporation and your partnerships go on. That's your passive income page. Okay. Page 1, go down where you see expenses, look at all the expenses, and then the last expense line says depreciation expense. It's the only expense item that has expense at the end of the name. Everything else does not. Why? Because the government wants you to understand and know this is a gift they're giving you. They're allowing that property, that physical property, and the same thing's in business with equipment. Any physical asset depreciates. It loses value. There is a tax benefit to that the government gives us because they want us to invest in these assets because it's a basic need for a roof over our head. If we don't do it, they're doing it. And how good is the government with our money, right?
Yeah.
So it's a partnership. They rely on us and to do this, and in return, they give us a tax benefit. That depreciation actually can be accelerated through a process called cost segregation. And what that means is that you're able to list out all the things in your real estate, physical properties, so countertops, blinds, appliances, roof, structures, and each has a depreciation schedule. You hire a special accountant firm tax team that specializes in cost segregation. They'll go through this and you're allowed to accelerate all of that to your first few years. Wow. Normally it could be as much, the structure is 28 years. So it could be as much as low as 1 to 5 years. That's awesome. But once you use that depreciation expense, guess what's going to happen? You're going to be in positive cash flow, positive passive income, which creates what? Tax liability. So what do you have to do? Go buy another property. Rinse, repeat, rinse, repeat, rinse, repeat. That's great for your wealth, great for your passive income, but at some point that passive income will outrun your tax benefit. Because if I have 10 properties passive incoming and I only have one new property that I get to do cost segregation, acceleration of the depreciation, all that income is going to bypass this. That's the problem with one particular asset. It's the same thing with business. It's the same thing with stocks, bonds, mutual funds. It's same thing with one singular focus of a asset. That's why the wealthy don't have just one asset class. They don't have just one business. They have multiple entities, multiple assets, how they hold the assets, how they title the assets, how they use the assets. And each asset does something differently each year. That combined portfolio on your tax return could create a low tax rate, which is why most of our wealthy have low percentage tax rate. They pay a lot of taxes dollar-wise, but their percentage rate is lower compared to, that's the IRS. Thank the IRS. Don't blame the rich, blame the IRS. But the IRS does it because it's a basic partnership need of those people to give these business for employees, equipment for making products and widgets and services and have employees, roof over your head, right? Life insurance. Business, real estate, life insurance are the three most tax benefit assets out there, but they're the most boring, but they are the most basics of needs. Well, how's life insurance a basic need? Well, if you don't have life insurance, the government has to take care of you because you have no money. They don't want to do that. Not because they don't love you, but because they don't love you. Right? So they give, just look at that. So when you're looking at stuff that has a good tax benefit, it's like, okay, the government doesn't want this. This has to be something that is a basic need. If it's something that does not have a tax benefit, like a W-2 employee, you have a lot of income, but not a lot of ways to reduce your tax. And when they do give you something like a Roth IRA, there's limitations. Give you something like a 401k or pension, there's limitations. When they give you, there's limitations of qualification. These other assets like real estate don't. So the real mind, again, reverse back to the beginning is, what's my purpose? What's your purpose? What's your goal? What's your outcome? Once we have this multifamily, what's the next level? Is there another level? Absolutely. And then once we have that, what's the next level? Absolutely. And you go on and go on as an asset class portfolio for your overall portfolio and your balance.
Well, and we see this a lot because that's the conversation that we dive into with our physician members, is we ask them, with each asset that they have, tell me about the purpose of this asset, because they may have some rationale that we're not aware of. So when we begin to get into that conversation, the most common thing that we find is, oh, it just seemed right at the time. Or I was told to do this. They don't understand the rationale behind that. And so I think that's, if we rewind to the highest level, yes, real estate is awesome. There's lots of different types of real estate, as Bob mentioned. I mean, from storage units to, mobile home parks. Like there's a lot of different types of real estate. There's different classes of real estate. There's different ways to invest in real estate. The bottom line is, if you haven't taken the time, or if you're the one who's doing all the research on this, you got to stop doing that. You're a great doctor. You're probably not great at doing this, and you know it. And so seek that help. Find a team who can help you. If it's us, we'd love to serve you. If it's not us, find someone who can help you identify those purposes behind the assets that you have and get it all working for you rather than fighting against one.
And here's one last comment from me, at least in this episode. You may have had a right purpose, and it may have made a lot of sense when you did it, but you may have evolved and changed today. Your situation has changed today. It may not be the right fit for where you are at today. So just because you did something doesn't mean that you dig in and you do everything you possibly can to keep that particular asset. If it doesn't fit who you are and your plan today, it's okay. Doesn't mean it was a bad decision. I get that a lot. It's like, oh, that was a bad decision that I made a mistake. No. You made a great decision at a time that it made sense for you based on the information you had at that time. You've changed. Things have changed. They've evolved. To my point about single family real estate and owning it.
Right.
Pre-COVID, it was a great strategy. It was a great idea. Post-COVID, and for a bunch of different reasons we won't talk about. But it does make sense for you to understand you have evolved. So please don't, and I bring this up because it happens a lot.
Right.
Saying I made a mistake then doing that. Or, oh, shoot, another. No. You're okay. And we'll tell you, right? We'll tell you assets that we get to keep using and assets that, based on the conversation with our team, with Aaron and our team, that, you know what, you've evolved. This may not be a good fit for you. So We'll help you along that way of what that looks like. So very important to understand.
Yeah. And everyone we talk to has such a unique situation. Like we were just talking before, one person asked us like, well, I own this property 5 states away. Should I keep it or not? Another guy this week was like, we own 10 different properties and some are under an LLC and some are under us. And, it's, again, we say the word hodgepodge a lot, but that's often what we're seeing is over the years, you've created this hodgepodge of assets and strategies, but who besides you is looking out for the whole picture and how it's affecting your overall tax rate, how it's all working together? No one. And so that's what we do. And I had 2 different people use the word unicorn this week alone. And I feel like when you hear something multiple times, like there's something to that. It's like, I feel like I'm looking for a unicorn. We've been searching and searching. We're not happy with our team. I'm like, we're your unicorn. That's what we've been so many years because this is such a pain point. And like you said, you haven't done anything wrong. There might just be a better way. And then we'll help you figure out, where do you want to go and what needs to change, if anything, in order to get you there. So we can help you with that. I feel like I learned so much in this short episode, Bob, especially like rental risk and I never thought about that. So thank you for sharing that. Yeah. And I think we'll talk more about real estate in some future episodes. But for today, we'll wrap up. So thank you again. Thank you for listening. And until next time, go be a wealth maverick.